Hi friends, I am Mani. I am the blogger behind getmoneyrich.com. Today we will discuss the topic of cost of capital. We will see how this concept of cost of capital will help us as an investor to evaluate an investment in a stock, and also how this cost of capital concept helps the businessman to make their investments. So this is, according to me, one of the most important concepts that we as an investor should know about. So I have written an article on this topic on my blog. If you want, you can go ahead and read that article. It is a detailed article. But just to explain you the concept of cost of capital, I will use a flow chart. And in this flow chart, you can see at the core, what you will see is the business. And this business has been expressed as two entities. One business focusing on operations and business focusing on growth. So we will discuss about that later. So first, this business is generating capital. It is getting capital in the form of equity, and it is also getting capital in the form of debt. And from where this debt and equity are coming, the debt is coming from the lenders like banks, NBFCs, or even us who buy bonds of companies. And from where the equity is coming, the equity portion is coming from the shareholders. We as a shareholder buy shares of the company, which in turn adds to the equity. The equity also comes from the reserves. We will see how the reserves are generated. So basically, the total capital consists of equity and debt, and these two ingredients feed business in terms of cash flows. And then the business, how the business use this cash flow. The business use it for operations. The business also use it for growth. And here you can see an entity called stock market. The stock market in general always looks at the total business, but its main focus is always on growth. Why always on growth? Because stock market loves companies which grows very fast. So we will see how that affects us as a shareholder. For the moment, let's concentrate on the operational side of the business. A business doing operations for what? It produces goods and services, it sells it to the market, and basically it does operations to generate profits. Why profits? Because it has to pay interest and it has to pay tax to the government, and what remains as a balance is called net profit. So generally speaking, we can say that a business operation is mainly focused to generate net profits. And here we will get our first component of the cost of capital. You can see the total capital. The capital is equity and debt, and because the company has generated this capital to run its business, it also has a cost. It must pay a cost to its capital generators. So interest is one component. The interest, where the interest goes? The interest goes to the lenders, banks, NBFCs, bondholders. Interest must be paid to them. So the first component of the cost of equity, cost of capital, is cost of debt. This is the first component. Just remember it. And in the total scheme of things of the business, where comes the cost of debt? You can see this in the flow chart. After the business has done the operations, it has generated some profits, and from the profit component it must pay the interest. Now, the company has already generated some profit. What's done with that profit? That profit is carried over to the balance sheet of the company. This is what we are seeing is actually happening in the profit and loss accounts of the company. Now this profit gets carried over to the balance sheet And in the balance sheet, there are two components. First is a part of the profit can go as a dividend to the shareholders, and a part of the profit goes to the reserves. This is what is called as a retained earnings. So this component, what you see here from the balance sheet, it is going as a dividend. This is another component of the cost of capital. So we will discuss that, but let's see what's happening here now. Now the business is taking capital in the form of equity and taking capital in the form of debt, and this capital they are also using to grow their company. How they grow their company? By buying new land, by installing new manufacturing facilities, by buying new equipments. So this is what we generally call as a capex, capital expenditure. So in a growth perspective of a business, what company actually does is it spends its capex. It buys lands, it buys equipments. So what this growth does? This growth increases the operating capability of the business, which in turn generates more profits, means more reserves and more dividends for the shareholders. But while this is happening, the stock market, you can see, is also seeing the total business, and especially its focus is on the growth. How fast the company is growing. This is what the stock market is always asking with its listed companies. A company which is showing good growth, immediately the stock market rewards the company by making their price grow. And when the price grows, there is a capital appreciation and the shareholders accordingly gets rewarded. So you can see the shareholders gets rewarded in two ways. First is they are getting dividends straight from the business, and then they are also getting the capital appreciation of their stocks from the stock market. And stock market is seeing the business, and it is accordingly rewarding the shareholders. So the two things, cost of equity and cost of debt, these two entities together builds the cost of capital for the company. A company who has taken loan from its lenders must pay interest, and a company who has taken equity, who has raised equity from the market, must also reward their shareholders in the form of dividends or in the form of price growth. So these two components, the cost of equity, the cost of debt, together forms what we call as a cost of capital. So there is a formula to calculate the cost of capital. In financial jargon terms, we call it weighted average cost of capital. Weighted average cost of capital, WACC. So what is the formula for WACC? WACC is the equity percentage of the total capital into cost of equity plus the debt percentage of the cost of capital into cost of debt. So how to calculate cost of debt and cost of equity, that we will see now. Suppose there is a company which has taken various kinds of which has raised debt of three types. First is there is a short-term loan they have taken from the banks or NBFCs, and that loan, suppose, is charging them 5% interest. Similarly, they have also taken some long-term loans, and that loan is charging them 7% interest, and on the bonds that they have issued, they have to pay 8% interest. So out of this, 30% is short-term debt, 45% is long-term debt, and 25% are the bonds issued. So the weighted average of these, the weighted interest that they have to pay on their overall debt load is this: 30% into 5, 45% into 7 plus 25% into 8%. So this becomes 6.65%. So the formula remember the formula for cost of debt is average interest payable. Average interest payable is, this is what we have calculated, 6.65 into 1 minus effective tax rate. What is effective tax rate? Effective tax rate, the income tax that the business has to pay on the profits that they have made. And remember, the income tax is always paid after paying the interest on the loans. So because the interest component of the debt is tax deductible, hence the effective tax rate of the company, which is generally made at 30%, it becomes slightly lower. So the formula for cost of debt is average interest payable into 1 minus effective tax rate. And how you can calculate effective tax rate? That is the income tax paid by the company divided by profit before tax. This information you can get it from profit and loss account. So I have assumed that for our example company, the average interest payable was 6.65% into the effective tax rate of 25%. I've just assumed. So the cost of debt becomes 6.65 into 1 minus 25% equals to 5%. So just remember this value. So remember two things: how the cost of debt is calculated using this formula that I have shown, and how much is the cost of debt. Cost of debt for the example company is 5%. Now let's calculate the cost of equity for a company. Remember, cost of equity is risk-free rate plus something extra. In financial terms, we call it risk premium. See, we as an investor has always have two options to invest. We can either invest in a risk-free option like a bank deposit, or we can take a risk and invest in shares. Why we will invest in shares when we have bank deposits? Because in shares we expect more returns. And how much is that more return? How to quantify that? The more return is the risk-free rate plus something extra. So you can say here the risk-free rate is, let's say, the interest offered by us on the bank deposit. That is the risk-free rate for us. And then the extra, let's define what is this extra. The formula of extra will look something like this. Cost of equity will be risk-free rate plus the stock beta into the average return that we expect from the market minus the risk-free rate. This is the formula. So when you apply this formula, you will get what we say as a cost of equity. So let's, for example, the risk-free rate prevailing in India, let's say, is 6% per annum. The beta for the stock is 1.2, and we are expecting that the Sensex or Nifty in next 5 years, let's say, it will grow at a 12% per annum. So Sensex and Nifty is growing at 12%, the risk-free rate is 6%, and the beta is 1.2. So what return our stock should give to us? This stock having a beta of 1.2, by applying this formula, should give 6% for sure, the risk-free rate plus extra. The extra is 7%. How this 7% is calculated? From this formula, beta into RM minus RF. So 6% plus 7% is 13%. So this stock, this example stock whose beta is 1.2, should give us a minimum return of 13% per annum. So again, two values we have now. Cost of equity 13%, and here the cost of debt was 5%. So we have two values. Now we will calculate the cost of capital. To calculate the cost of capital, we have to use this formula, WACC into the equity component of the debt into cost of equity, and the debt component of the capital into cost of debt. So just for example, I have taken a value from a company listed in the stock market. Here the company had a total share capital of 98.86 crores. It has a reserve of 3,500 crores and it has taken a debt of 5,690 crores. So you can see, out of the total capital will be this plus this plus this. So out of this total capital, equity is 39% and loans are 61%. So the equity component of the total capital will be 39% from here, and the debt component of the total capital will be 61%, the value taken from here. Just for example, I am showing. And we have already seen the calculation where cost of equity we have calculated as 13% and cost of debt we have calculated as 5%. So what will be the weighted average cost of capital? 8.12% by applying these numbers on this formula. So what is this WACC? WACC is nothing but the cost of capital. What we are discussing in this article is cost of capital, and to calculate cost of capital, what we actually need to calculate is weighted average cost of capital. So 8.12 is the weighted average cost of capital that we commonly refer as cost of capital. So what is the use of this cost of capital? Basically, the cost of capital can be understood from two perspectives. One from a businessman's perspective and one from an investor's perspective. A businessman uses this calculated value of cost of capital to evaluate his new ventures. Suppose his team has told him that we want to install a new manufacturing facility, and that manufacturing facility seeks sanction from the business owner. So what the business owner will do? The business owner will ask two things from his team. First of all, he will ask, what is our weighted average cost of capital of our existing business? Suppose the weighted average cost of capital was 8%. Then he will ask, show me the numbers that what will be the profitability of this new venture. For sure, to get this scheme passed, the new venture should have a profitability, and when I say profitability, it can be ROCE or ROIC. So to know more about ROIC, you can check this link, and to more about ROCE, you can check this link. So I will not go into detail of ROIC and ROCE. So the businessman, what he will do, he will compare the two numbers. He will compare WACC with ROIC and ROCE. ROIC and ROCE should be substantially more, at least 1.5 times more than WACC. Only after that he will sanction the new venture. So this is the cost of capital, how a businessman will use the concept of cost of capital. How we as an investor will use the cost of capital. So we will do two things. First of all, we will self-calculate the weighted average cost of capital. We can calculate that by using this formula. Secondly, we will also focus specifically on the cost of equity. Here the cost of equity we have calculated as 13%. So the first question that will be answered for investor is, this stock should give us a minimum return of 13% per annum, or in other words we can say this stock is capable of giving us a minimum return of 13% per annum. Is it sufficient? This is the question that we have to ask ourselves. Is 13% return good enough for us? If the answer is yes, then we will jump to the next step. What we will do in the next step, we will then compare the weighted average cost of capital with the past ROCE and ROIC of the company. If the ROCE and ROIC has been at least 1.5 times more than WACC, we can say that the company is sufficiently profitable to meet the demands of WACC. It means that if ROCE and ROIC are sufficiently large in value, only then it can give interest to its lenders. Only then it will be able to give interest to its lenders, and it will be able to pay dividends and compensate with price appreciation to its shareholders. I hope you have understood the concept of cost of capital in this video. If you want to get a more in-depth perspective on cost of capital, I will request you to read the article. That's all for now. I will see you with another video very soon. Thanks for watching.